Well, hello, folks. Glad to have you. Tom Dixon here with the Financial Experts Network. Actually standing today, just talking about standing desk. And it's the first time I've had this desk for a long time that I'm actually standing when kicking off the webinar. So anyway, delighted to have all of you today for a webinar that I've long wanted to do, really focused on life insurance illustrations. Speaking for myself, I find them confusing, and I think my guess is many of you do as well. So delighted to have actually a pioneer in this area of really trying to bring some sanity to life insurance illustrations, and that being Barry Flagg, the founder of Veralytic. And then alongside of Barry, to present the view of BGA is my new best friend in the life insurance space, Bob Vandy, president of Advisors Insurance Brokerage. So delighted to have both of them here today. And as always, certainly would love everyone to say hello in the question panel. And by the way, let me know when you do if you personally have a permanent life insurance policy. I think that'd be interesting to know. So now I'm going to jump into the preamble and try to move through this. I'm trying to get better at this. Let me just start with quickly, if you're not connected on the financialexpertsnetwork.com site, please bookmark that so you can find out about all upcoming webinars. So again, you should have that website bookmarked in your browser. Let's connect on LinkedIn. Look for me personally, Tom Dixon, D-I-C-K-S-O-N. You should also connect with the speakers that are on here, of course, as well. Today's session is worth 1 CE credit for all of you that are subscribers or members of the Financial Experts Network community. And for those 5 designations on the screen, plus we provide a certificate for those of you that are NAPFA members that you can use to self-report your credits for that purpose. And we also provide 1 CPE to those of you that are CPAs. Now, to ensure you get these various credits, you must stay on for the entirety of the educational webinar, and you must be logged into your computer, not listening by phone. And by the way, I always recommend you use the phone line. It gives you a better audio quality for those of you listening through your computer. Now, a copy of the handouts for what Barry and Bob are going to walk through today was emailed to you. If you don't see that, look at that handouts icon on the GoToWebinar screen to download a copy of the materials. Replays are always made available. Again, check out our website, financialexpertsnetwork.com. And as always now, we will present 3 polling questions during the webinar at various points along the way, and then 2 questions before we open up for Q&A. I appreciate your participation in that, along with the survey that will be presented at the conclusion of the webinar as well. I will tell you, you can start posting questions. We already have our first question. That's pretty neat in the question panel. And again, Bob and Barry will take questions at approximately 4:55 Eastern. Now, let me make it clear. If you need to jump off and you're a member, you can jump off at 5 Eastern. We'd hate to see you go. That's really when Q&A will start. But again, you'll have earned your credit if you're on at that point in time. And again, I will timestamp that as well. Now, for those of you listening as a guest, delighted to have you. If you want to earn CE or CPE for today, plus get great access to subject matter experts like these two as part of 80 live webinars that we will host this year, go to the website, financialexpertsnetwork.com, follow that trail. For literally $12 a month, you can get 2 live webinars a week or more and join a community of over 500 CPAs, financial planners, and other professionals. So with that, again, delighted to have all of you. I'm just going to hand it over to Barry. And to me, this is very timely because what you're going to hear is and learn, if I'm sure you got a sense of it, is really the life insurance advice business is being disrupted. And I'm delighted to have one of the chief disruptors, Barry, on with us today. So Barry, it's all yours, and please let me know if I can be of any help.
Sure. Thanks, Tom. Always fun to be on your network. As Tom mentioned in the email for this webinar, and as he mentioned in his comments, he's been asking me to do a webinar on life insurance illustrations for some time, as I actually have some others. And between Tom and discussions with Bob, and some things I've been reading both in the press and on LinkedIn, it came to me how to talk about illustrations. And I think it's important, more important now than in times past, because there's a recent change in the definition of life insurance that makes life insurance more attractive now to high net worth individuals, and particularly ultra high net worth individuals. I read this morning that now that the COVID relief legislation has been signed by President Biden, they're moving on to tax reform, which for this administration I think is probably a euphemism for tax increases. And life insurance has 4 tax preferences that are unique to life insurance, that are beneficial to those in high tax brackets, high income tax brackets, or confiscatory estate tax brackets. At the same time that we've got life insurance, definition of life insurance rules changing, making it more attractive, and taxes going up, making it more attractive, the various jurisdictions have issued best interest rules specifically for life insurance. The CFP, for the CFPs on the webinar as well, the CFP Board updated their practice standards and now applies best interest rules to life insurance product recommendations, due diligence and recommendations. And all of that is redefining, all of those best interest rules are redefining how financial advisors really have to evaluate and recommend life insurance. And if you're not the one actually doing the recommendation, if you're working with a life insurance professional or working with a BGA, it really requires you to reevaluate how you're getting the decision support for your life insurance recommendations. These new best interest rules require new tools and different execution. I call it best execution. The life insurance world is moving more towards the investment business, which is actually where I came from. I started my career in the investment business as an analyst in a pension investment advisory department, and I used something that now is ubiquitous in the financial advice business. I used Morningstar to evaluate mutual funds, which funds had high cost, which funds had low cost, what might be some better funds. And then I went to go work for a life insurance agency where I was told that due diligence or decision support involved running one illustration that was never going to come true and compare it to some sales proposal that was never going to come true. And so that never made any sense to me. And hence my difficulty in responding to Bob's request for a webinar on understanding illustrations. But again, between Tom and Bob and I think we've come up with something that will be helpful and of interest, particularly with Bob's perspective. I bring the perspective of this Morningstar approach that I had when I was a 19-year-old kid in a pension investment advisory department, but Bob brings a very practical approach. So I think this is going to be good. Bob, did you want to add anything?
Thanks, Barry. Yeah, the only thing that I would add is just, it's very interesting. I think that we've gotten to the point where we are from different approaches. I've taken a little bit more of the traditional approach in terms of how I've arrived at this point. That is, I started as a career agent in the life business. I progressed into a couple of home office positions at life insurance companies, and then have come back, 18 years ago now, into what I would call traditional brokerage general agency setting. And we've seen a lot of change. I started in the business in 1990. And I've seen a lot of change during that time, but I've approached it from a mentality standpoint from that more traditional trajectory, if you will, as I've gone throughout my career. So I think it's interesting. You've come at this position where we are today a little differently than I have, but one of the things that I've concluded from our conversations together, not only where we are now, but more important, where we're headed, and we're going to talk a lot about that, is we're like-minded. You know, where we are, and more important, where we're going to go here in the future. I think that things, the way they look today, are not going to look the same way 1 year, 5 years, 10 years, et cetera, from now. And it's the well-prepared and well-positioned financial advisor that's going to be in a position to benefit from that. And by extension, their clients are going to benefit from that.
Could not agree more. So let's dive in. So yeah, I don't think you can have a conversation about life insurance, at least not a planning conversation about life insurance with a client, without an illustration. And there's good reason for that. They are very useful for some things. They include some very valuable information. So let's talk about what are they, and what are they good for. Illustrations are a depiction. That in the actual illustrations are defined in something called the National Association of Insurance Commissioners Illustrations Model Regulation, and in that regulation, illustrations are defined as a depiction. Not a representation, not a forecast, not a prediction, but a depiction of non-guaranteed elements of a life insurance policy over a period of years. And that depiction is comprised of, nowadays, 50-some pages, thousands of numbers, dozens of disclaimers and footnotes, and then since insurance companies got sued years ago, before they asked the client to sign on the bottom, on the proverbial bottom line, saying that they understand everything in that 50-page document, it now more often than not includes an attestation of understanding, where the client has to sign and say, yes, I understand everything in this 50-page document. These illustrations, or this depiction, is based on the insurance company's cost of insurance charges. In other words, what they deduct from the policy account to pay death benefit claims, the expenses that they charge for design, marketing, distribution, underwriting, administration, what have you, and what they expect, or what is reasonable to expect, in some cases what's unreasonable to expect, in earnings on premiums paid in excess of 1 or 2 of the cost of insurance charges and the expenses. All of which can and do change over time. So the illustration, which is it's like a scrambled egg. It's a compilation of these three things, the cost of insurance charges, the expenses, and the interest. It's like scrambled eggs. It's impossible to understand a scrambled egg once it's already scrambled, or what are the ingredients in a scrambled egg once it's already scrambled. So if there's one thing to take away from this webinar, please take away this formula, that one of the most important things to understand in any illustration is not the premium, not the hypothetical cash value, which can change, not the death benefit, which can change, but what are the cost of insurance charges, what are the expenses, and what is the interest? We'll see in a little bit. These are the things that really matter, and we'll talk a little bit more about how to get those, or make sure you have them. So this depiction, even if you don't get the cost of insurance charges, the expenses, and the breakout of the cost of insurance charges, the expenses, and the interest, this depiction is nonetheless useful for understanding how the policy works, how better or worse interest or investment performance could impact the performance of the policy. It's useful for doing what-if analysis. What if I stop paying premiums? What if I pay more? What if I decrease the death benefit? How long will my coverage last? These are all illustrations are very, very useful for these types of what-if analysis. And there's certainly, I know we have a good many financial planners on the phone, on the call, on the webinar. They're certainly good for modeling, cash flow modeling, or including in our planning. So some people say I'm really negative on illustrations. I'm negative on some things on illustrations, but they are very, very valuable, include very important information, for these type things. What illustrations are not useful for, and this is where I do get a little negative on illustrations, these illustrations are hypothetical projections. They are not useful for understanding the competitiveness of internal policy costs, and we'll have an example for the reasons why that is. They are not useful for understanding the reasonableness of performance expectations, and we'll have an example for that. And they're not useful for understanding the appropriateness of risk relative to the client's risk tolerance, and we'll have an example for that. These are the three things that, under proven and established best interest rules, are the three things that most influence the appropriateness of a particular product recommendation, or the determination of whether a product recommendation is actually in the client's best interest. Are cost justified? Is performance reasonable? Is risk appropriate to the client's risk profile? None of these things can be discerned from this depiction or this illustration. I do know, however, that just from experience in the business, that there was no other way to really do due diligence in the 1980s. And so I know it's a common practice, has been a common practice, to get an illustration from one insurance company or one broker and get another illustration from another insurance company or another broker and compare the premiums, and the one with the lowest premium is the one that gets recommended. As Bob said, we are moving away from, we're moving in a different direction that we'll talk more about here. And the practice of comparing hypothetical premiums is really old school, and we're going to talk about new school. So here's an example of why why comparing hypothetical premiums just doesn't work in the current environment. And it has always been true, but it's never really been this untrue, or this problematic. So these illustrations, as we said earlier, these illustrations are calculated, premiums are calculated to cover cost of insurance, charges, and expenses, assuming some particular interest rate. And in this case here, this is a real life illustration. These cash values and premiums are calculated apparently using a 5% interest rate. And so if you think about, what best interest rules require: justify costs, set reasonable performance expectations, and understand risk. Well, 5% interest rate is probably a pretty conservative interest rate. It's pretty achievable. You can invest in asset classes that are not that volatile. It's conservative. That would be perfect for a client with a conservative risk profile. But if we dive deeper into this particular illustration, into these pages that are so important, that unfortunately you got to ask for more often than not. But if you dive deeper into these, what I call these detailed expense pages or policy accounting pages that show the cost of insurance charges and the expenses and the interest required to make the illustration work, or to make the policy work as expected from the illustration, this policy actually requires a 13% rate of return. This is a direct snapshot from the illustration. You can do the math yourself. $15,000 of interest on $116,000 of account value is approximately a 13% rate of return. Well, a 13% rate of return is anything but appropriate for a client with a conservative risk profile. In fact, that is a aggressive or ultra aggressive risk profile. And so, and as we said, under these new best interest rules, it's important to justify costs, set reasonable performance expectations, and understand risk. Well, there is nothing in the illustration that quantifies the risk of additional premium calls if you don't get this 13% rate of return. I guess there is some in the proverbial fine print disclosure as to the risks of getting lower cash values, because they do show the cash values at alternative rates of return, and the risk of a lapse. But it is on the front, as we saw a minute ago, on the front page it said 5%, And you've really got to dig down deep into the illustration to find these other disclosures. And more often than not, clients don't want to do that, and you end up with a disappointed client. So Tom, that brings us to our first polling question. I know that you need to do something technology-wise on your end to actually give people the option of choosing this, but polling question number one is, hypothetical life insurance illustrations are not useful for understanding how the policy works. Remember, this is a negative. I'm asking for the opposite here. They're not useful for understanding how the policy works. They're not useful for understanding how better or worse interest or investment performance will impact the policy. They're also not useful for helping me spell the word how correctly. They're not useful for performing what-if analysis. They're not useful for doing cash flow modeling, or they're not useful for determining which product is in the client's best interest.
All right, folks, here we go. You should have a little pop-up window that you see where you can opt in, and please use that window to answer the question at the question panel. And I will leave it open for roughly 30 seconds. Certainly appreciate your participation. By the way, continue to post questions for Barry and Bob anytime that you like. And again, we'll open it up for Q&A at approximately 4:55 Eastern. So we're going to let's give it 5 more seconds, and then we'll close it, and then I'll push it back to Barry. Here we go, folks. 3, 2, 1, and Barry, let me just share the results. Hopefully you can see that. The determining the last one was the most popular vote. And if you would confirm which one's correct, that would be helpful.
Determining which product is in the client's best interest is not, illustrations are not useful for determining which product is in the client's best interest for some of the reasons we've already talked about and are going to dive deeper into. So, I often am asked, when we talk about, how can life insurance companies show one rate of return prominently disclosed above the columns that are supposedly calculated using that rate of return, and then actually calculate the cash values and the premiums using a different, aggressive, riskier rate of return without disclosing that additional risk or that higher rate of return. And the reason is, unintended consequences from a well-meaning regulation. I referenced it before, that the NAIC, National Association of Insurance Commissioners, illustration model regulation was well-intended, and I'll explain why in just a few minutes. But under its current iteration, it permits agents and brokers and insurers to quote a low premium while charging high costs without disclosing the higher risks of additional premium calls and lapse, which is kind of what we just saw. And the reason for this is the NAIC illustrations model regulation came out in the 1980-ish time frame with the advent of universal life. And whole life policies had a fixed premium. Universal life policies had a flexible premium. So the National Association of Insurance Commissioners issued this reg to try to give insurance companies and agents and brokers the ability to calculate a premium on an apples-to-apples basis, so that premiums were a proxy for cost. And so just the way it's still being done today, the policy with the lowest premium, it was intended that would be the policy that has the lowest costs. But as we'll find out, and as is discussed, for those of you who follow Michael Kitces, who read Michael Kitces, and if you don't follow him, I've got permission to share this article that he wrote based on a white paper that I first wrote. It was so this NAIC model reg was well intended, but it is, as Bob says, not where we're headed anymore. It's not supporting where we're headed anymore. Michael wrote a 2-piece article. where we're going is in this what I call the relentless march toward clients' best interests. It started for me with ERISA in the 1980s, and most recently it's been reinforced by the New York Best Interest Rule for life insurance, the SEC Reg BI, the change to CFP practice standards, all of which are redefining the meaning of clients' best interest for product recommendations. And in that article, you'll see exactly why premiums are no longer useful, why the NAIC illustrations model regulation just isn't working, and actually hasn't been working, but it's really not working right now. So, you know, the Kitces article talks about a real life situation where a financial advisor requests from his friendly agent, broker, directly from the insurance company, whatever, illustrations from a couple of companies. And I'm going to pick just two of them here. One of them is a indexed universal life policy with a premium of $13,000, and a universal life policy with a premium of $8,500. And if the premium actually were a proxy for costs, this would be an easy decision. You'd conclude that the universal life policy has the lowest premium, because, by the way, it's, as is outlined in the Kitces article, the illustration request was very specific. Calculate everything using the exact same rate of return. But if you dive a little deeper, onto page 5 of the Kitces article, you see that actual costs for the universal life policy, for the IUL policy, are $822,000 over the expected coverage duration. But costs for the universal life policy are 50% more. So how in the world can the premium in the universal life policy be less, but the costs be 50% more? And it goes back to that glimpse. It's explained in detail on page 6 of the Kitces article. By the way, the Kitces article is a 2-part article. This part is in, this example is in the first part. But it's the reason why premiums can be lower when costs are higher is because of a quirk in this NAIC illustrations model regulation that we took a glimpse of earlier, where the interest rate appears to be one interest rate, but the actual rate used to calculate premiums is a lot higher. And we can see in the example, at one point in time, on page 6 of this Kitces article, you'll see the policy account value is $100,000. And you don't need a calculator to figure out that the interest at 5% on $100,000 is $5,000. But as you'll see in that table, in the Kitces article, just like we saw before, the interest actually required to make the illustration work is $14,000. It's 14.2%. And this is not just a anomaly for this particular universal life policy or this particular index universal life policy. This is a glitch in the NAIC illustrations model regulation that just about every insurance company is doing this to some degree or another. And I will emphasize just about every, which means not every. And so, this rule was designed to help illustrations be more understandable, that a illustration with a lower premium would reflect the policy that had the lower costs. But this rule is just subject to, since the insurers know that the premium that the clients are going to buy off the proposal with the lowest premium, they're finding ways to calculate the lowest premium one way or another within the confines of this rule, which, by the way, is the only rule in the financial services business that I'm aware of that doesn't, as we'll talk about in a minute, do what best interest rules require. It doesn't involve a calculation. Best interest rules require, like we said earlier, justifying costs, costs, not some derivation of costs, but justifying costs, establishing or evaluating the reasonableness of the performance expectations, and understanding risk. The NAIC themselves has even concluded that their model regulation has resulted in a lack of uniform practice among different insurers. And as we said, it doesn't disclose, it doesn't require disclosure of costs or performance or risk for that matter. Since the issuance or promulgation of the illustrations model regulation, FINRA issued a rule for variable products saying that it's inappropriate to compare illustrations because doing so without actually examining costs, performance, and risk is misleading. The Society of Actuaries a long time ago said that comparing illustrations is fundamentally inappropriate. And most recently, the OCC updated their handbook for unique and hard to value assets to add a chapter for life insurance in which they caution fiduciaries that these illustrations are subject to a high degree of fluctuation, and just not anything that's subject to a high degree of fluctuation is just not reliable for product recommendations or as decision support for product recommendations. So, Tom, we've got polling question number 2. Let me know when you're ready for me to read it.
I am ready. Absolutely.
Okay, so comparing illustrated premiums, cash values, and death benefits as decision support for product recommendations is permitted by CFP Board, is permitted by FINRA, is permitted by the New York Best Interest Rule, is permitted by the NAIC, the National Association of Insurance Commissioners, is permitted by the SEC, or and is, well, I guess the Society of Actuaries doesn't really permit or not permit, but say accepted by the Society of Actuaries.
Well, I'm glad you made that comment, Barry, because I could not squeeze 6 options in GoToWebinar. So, and again, folks, if you don't see the window for the polling question, you may need to minimize the presentation screen. It's most likely hiding behind one of your screens if you don't see it, but it seems like we have a lot of folks participating. Certainly appreciate that. And again, if you have questions for Barry and Bob, feel free to post them in the question panel. Delighted to get through as many of those as possible. And let's leave it open for 5 more seconds. 3, 2, 1, and here we go. And Barry, let me just share these again. 86% said NIAC.
Okay, got a smart audience here, Tom.
Well, we work on it.
You got
Great
smart,
community,
smart followers, smart community.
Yeah.
So illustrations are useful for some things, but as I've probably beat the dead horse, they're not useful for determining or as decision support for product recommendations, at least not under best interest rules. And so if you can't use or if it's not prudent to use illustrations as decision support for product recommendations, what are some practical alternatives? And Bob, I know that you've wrestled with this because you're in New York, and that New York is the only state that has issued a formal best interest rule. These other best interest rules certainly apply nationally if it's a certain product type or if you're a fiduciary advisor. But what's going on in New York? What are you doing?
Well, it's interesting, Barry, because yeah, we have been dealing with what I think is probably the industry leading by state, that is, regulation for best interest as it relates to both life insurance and annuities here in New York under 187 for over a year now. And our philosophy as a firm has always been that, you know, as any BGA would tell you, I would hope that our goal overall is to be as objective as possible to offer up choices to that advisor so he or she can do the best possible job for the client. And so we obviously want to gather as much intel as we can and provide a number of choices to that advisor so they in turn can then take it to the client. And we have certainly had to change our approach to the business here in the state of New York. What we've philosophically done is we've extended that beyond the borders of New York, really for the reasons that you alluded to earlier, Barry. And that is this whole notion of where we are today versus where we're going. And I reiterate that you and I are like-minded on that, in the sense that and we've talked about this, and the analogy that I use is the Wayne Gretzky quote that gets overused, so I won't repeat it word for word. But this whole notion of skating to where the puck is going, or we need to get out in front of things and go where we see the industry is headed. And if nothing else, Reg 187 in New York is certainly a harbinger of where things are going to go state by state as time goes by. So our philosophy has been, why not try to get out in front of it now? So we have upped the ante with regard to how we have put information out there, the number of alternatives that we've put out there for the advisor when they call for support to us, so that they can do the best job possible in doing that. So, from a philosophical standpoint, our goal is to not only provide the choices, but to provide the number of options in an objective way. We're not beholden, as any BGA would tell you, they're not beholden to any one particular or two particular carriers. And one of the best ways that you can do that, and you're going to talk about this, I know, is this whole notion of including some select pages and illustrations, one of which is the specific page that it has to do with costs and expenses, and you alluded to that in your equation that you shared earlier. So we're trying to do that more and more, and we think we're doing a pretty good job. We've got room to improve, as everybody does, but we'd like to think that we're a little bit ahead of the curve, and maybe we need to sharpen our skates a little bit like everybody does, but we're going to get there. So by employing some of these different methods, I think we can certainly do that.
Yeah, as I alluded to before, I call this the relentless march towards clients' best interest. We're not, and I don't know that that's actually a destination. It may be one of those things that you keep striving for. Everybody's on the journey. I'm on the journey. I happen to maybe start a little earlier just because I started my career in the fiduciary business first, or the client's best interest first. But we're all on this journey, and I think it's important for attendees here to understand that everybody's on the journey, and that not everybody is at the same place in the journey. And so, justifying costs, evaluating the reasonableness of performance expectations, assessing the product risk relative to the risk tolerance, all of those things require a big shelf, because if you're going to justify costs, if you only have one product to sell, you can't justify costs because you have no idea what the peer group is. So you need a big shelf, you need the tools and the tools to evaluate cost, performance, and risk. And the thing that is, I think, is particularly important for financial advisors and fiduciary advisors, CPAs, CFPs, attorneys, certainly fiduciary advisors, but they're not as actively involved in life insurance in the actual selection or retention of decisions for life insurance. But any fiduciary advisor has a duty to exercise reasonable care, skill, caution, diligence, and/or prudence, depending upon your code of professional conduct. And as the industry moves down this road, moves through this journey away from the illustrations model regulation and more toward these best interest rules, I just wouldn't want to be the person that is trying to defend that I've exercised reasonable care, skill, caution, diligence, and prudence, and then explain that I've got documents in my file that FINRA thinks are misleading, that the Society of Actuaries says is fundamentally inappropriate, and that at the OCC or the U.S. Treasury says is unreliable. To your point, you got to skate to where the puck's going, not to where it's been in the past.
Can I add one more comment to that, Barry?
Yeah, sure.
And my second, and I think final overused comment would be, it's not your grandpa's life insurance anymore. I know that's one that you and I have used together in some of our conversations. And I don't think that's emblematic of this group that we're talking to today. But I think the time certainly has come, and some have come kicking and screaming, but the time has come for us to recognize that if your approach to the life insurance conversation is get a single proposal, put it in front of the client, and as you've described, do it in such a way that this is the best performing policy out there. If that's the philosophy that you're approaching the conversation with, A, it doesn't work today, and B, it's most certainly not going to work tomorrow. So I think it's so important that all of our attendees today take that to heart.
Yeah. I mean, I just think if you're familiar with the investment business, the life insurance business is going to look more like your business than the life insurance business of old. When I was 19 years old using Morningstar, I didn't run a hypothetical projection of, Fidelity's mutual fund versus Vanguard's mutual fund to figure out which one had lower costs. I looked it up in an independent resource, and that's where I think we're headed anyway. So what are the practical alternatives? And as I already alluded to, if you're a fiduciary advisor with a duty to exercise reasonable care, skill, and caution, just do not have documents that FINRA considers misleading, Society of Actuaries considers fundamentally appropriate, and the U.S. Treasury considers unreliable. I serve one of my companies serves as sub-advisors to a couple thousand life insurance trusts, all fiduciary accounts. And first thing I say is, if you've got some premium comparison in your files as decision support for your pre-acceptance review or your post-acceptance review or your annual review, get them out of there. Do something else. At a minimum, get these detailed expense pages. You'll see what they look like. If you're a subscriber to Michael Kitches's Nerd's Eye View, you can look it up. If you're not, you can reach out to me, and I'm happy to. Or sorry, it's available from the downloads or the handout section of the webinar. But you can see in there what these detailed expense pages. They're also sometimes called policy accounting pages. Different insurance companies have dozens of different ways of naming them, but you'll see what they look like, so you'll know what to look for. But even better, again, I didn't pull 2,000 when I was a 19-year-old kid in the pension investment advisory business. I didn't pull 2,000 prospectuses and read them and try to figure out what was in them. I subscribed to Morningstar. I benchmarked the performance of a particular fund or funds against the S&P 500 or against the Morningstar average or what have you. Benchmarking is common and well established in every segment of the financial services business except life insurance, and I think that's in the process of changing too, particularly for advisors who have a duty to exercise reasonable care, skill, caution, prudence, and diligence. So Tom gave me permission to tell you a little bit about how Veralytic does its benchmarking. So we benchmark 5 things. We benchmark financial strength and claims paying ability, which you can get elsewhere. We benchmark the competitiveness of internal policy costs, not hypothetical premiums, the competitiveness of actual internal policy costs. The stability of illustrated expectations. So the Veralytic system actually doesn't just pull the rate of return above the hypothetical columns on the first page. It actually examines the rate of return required in those detailed expense pages to make the illustration work. It evaluates the accessibility or restrictions on account value. And it looks at, just like every other segment of the financial services business, it looks at actual historical performance. Not that historical performance isn't a guarantee of future results, but it is an accepted way of determining whether or not one company is a better investment manager or bond manager in the case of a lot of life insurance companies, or not a good bond manager. The great unknown in the life insurance business, though, is costs. The costs vary greatly, as I'll show you in a minute, but they're hard to get. The Veralytic report, however, reveals costs at a glance. So for instance, this is a zoom in on the policy expense breakdown chart inside every Veralytic report. It allows you to understand at a glance just how much is being charged inside any existing or proposed policy, as shown here on bar number 1 on the left-hand side of this little Zoom window. And it also shows whether these costs are competitive or excessive relative to industry benchmarks. For bigger policies, shown here in bar number 2 in the middle, and for smaller policies, shown in bar number 3 on the right. The advantage of benchmarking versus just comparing some limited number of quotes is that benchmarking reveals just how competitive or excessive costs actually are relative to the entire universe of peer group alternatives, where I said costs vary considerably. They vary by as much as 80%, which means that worst available rates and terms are 40% higher than the average, and best available rates and terms are 40% lower than the average. So in this case here, you can see that this in-force policy or policy being recommended is among best available rates and terms, and you can see it at a glance. You don't have to evaluate thousands of numbers or 50 or dozens of pages. You can see it at a glance that this product is, the costs in this product are among best available rates and terms, not because somebody says so, but because an independent ruler reveals that. Benchmarking is also useful for seeing and, more importantly, quantifying when costs are excessive and by how much. So for instance, in this, again, this real life policy available for sale today, this real life policy charges 17 cents, and this chart shows the cost per dollar of insurance. So it's 17 cents per $1 of life insurance. We said before, or we saw before, that the boundary for best available rates and terms is closer to 10 cents. That means that the cost in this policy are 7 cents more than best available rates and terms. And you can see at a glance with just some simple math that for $1 million policy, if this was an in-force policy, you could capture $70,000 in cost savings for this client. I know when I give this presentation to a live audience, I get questions. There's no way that can be. And I assure you, it absolutely positively is true. And if you give it a try, Bob and I can show you exactly how to capture those kind of cost savings for your clients. Benchmarking is also well established for benchmarking returns. As we saw earlier, insurance, the NAIC illustrations model regulation permits insurance companies to show one rate of return prominently on the cover page, but then actually use some bonuses inside the illustration to calculate premiums and cash values and death benefits using a different rate of return, a higher rate of return, which adds risk. All revealed at a glance in a Veralytic report. So whether you use Veralytic or something else, or just get those detailed expense pages, benchmarking is certainly a lot faster than comparing illustrations. It's easier because you're just, you can see things at a glance and you can calculate things using simple math. It's complete because it compares against not just 1 or 2 or 3 or 10 others. It compares against the entire universe of alternatives, universe of peer group alternatives. It's reliable. It's been reviewed by FINRA. It's independent, which is really important. If you haven't read anything about the Key Bank case, which was a complaint by the Cochran family against Key Bank involving a life insurance policy, the court found for the bank, in part because they relied on independent information from a third party with no economic stake in the outcome. I think that's going to become quite important in the future of life insurance. And it's well established and proven in every other segment of the financial services business because it avoids misleading, inappropriate, and unreliable illustration comparisons, and is considered consistent with a fiduciary's duty to exercise reasonable care, skill, caution, and diligence. So our last polling question, Tom, is, tell me when you're ready.
I am ready.
So decision support for product recommendations per the various best interest rules does not include justifying, and again, this is again one of those questions in the negative. So it does not include, best interest rules do not include justifying costs. Best interest rules do not include evaluating the reasonableness of performance expectations. Best interest rules do not include assessing product risks relative to the client's risk profile. Best interest rules do not require that advisors act with care, skill, caution, diligence, and prudence. Or best interest rules do not include comparing hypothetical premiums, cash values, or death benefits.
All right, folks, again, here we go. And hopefully you see the pop-up window. Again, if not, you may need to minimize the presentation screen. And again, let's give it another 20, 25 seconds, and we'll, I'm just going to then present two quick polling questions, and we will go to Q&A. Barry, I think you're done with your slides. Is that correct? Or
actually, we are going to move to Q&A, but I want to start off with a question. So I do have a few more remarks.
Okay, give me. All right, folks, let's give it 3 more seconds. 2, 1, and let me, Barry, let me just share this again. 68% the comparing hypo, premiums, cash, etc. That was the most popular vote.
Again, smart audience.
Okay.
So for the questions, as I said, I wanted to start off with one. So if you're a fiduciary advisor, if you're an advisor that, you know, a CFP, a CPA, a trustee of a life insurance trust, somebody who advises a trustee of a life insurance trust, anyone with a duty to exercise reasonable care, skill, caution, prudence, and diligence, ask yourself this question. Why would somebody get these 50-page illustrations and put them all into a spreadsheet, manually reconcile and equalize the rates of return that we saw earlier, that if that's even possible, read dozens of pages of footnotes and disclosures, versus, and we talked about benchmarking before, submitting just one illustration, which takes, you know, it takes as much time as sending an email or sending a fax, getting a benchmark report for all 5 major considerations of competitiveness against the entire universe of alternatives, that's rules-based, which means that it's consistent and reliable, not prone to human error, not as prone to human error. It's data-driven, it's complete, again, versus the universe. It's independent, resolving conflicts of interest. It supports best interest rules. Why would anybody, you know, do that? Why would anybody go through the spreadsheeting process? I just don't understand it. Frankly, and I've thought a lot about it because frankly, I don't know why I don't have more customers. But in any event, there are a number of providers who have developed search engines which automate the process of spreadsheeting. So that at least takes away the time component. However, and these search engines are very useful for understanding the available products and gathering data, no doubt about it. But remember, they are still pulling their data, their search engine data. They're pulling that from the illustrations that FINRA says are misleading, the Society of Actuaries says are fundamentally inappropriate, and that the OCC or the U.S. Treasury says are unreliable, right? So you need more than just what the search engine provides. I'll give you an example. The search engine here displayed on the screen ranks this particular product, and I'm not going to pick on anybody, so you know, it's just a particular product, but this particular product is that's ranked number 1 all over this page, is the exact same product that I talk about in the Kitchus article, or that Michael and I talk about in the Kitchus article, that has really high costs and really high risks. So just a search engine that just automates the spreadsheeting process doesn't mean you're getting decision support that would comply with reasonable care, skill, caution, diligence, and prudence. Here's another example of a decision support, of a search engine. As I said, it's really useful. It shows you what all the products that are available for a particular client profile. So very useful. But once again, it gives us premiums, it gives us death benefits, it gives us cash values, but it doesn't give us an evaluation of costs where we have, where we can see the cost at a glance in a Veralytic report. There's no evaluation of the reasonableness of performance expectations, which again, you can see, or you get decision support for when you're benchmarking performance against industry averages. And there's no evaluation of risks, which again, we saw a minute ago is elementary to benchmarking and part of a Veralytic report. If you wanted to give Veralytic a try, you can have one on me. The web address is long. I don't know if you're going to have time to write it down. An easier way to do it is just to Google, or if anybody uses Bing, search for complimentary Veralytic report. It should be your first hit at the top of that search page. You can also email info@Veralytic and we'll get you one. Either way, do make note of this. The only way you'll get a complimentary Veralytic report is if you include this promo code in your request. And for Tom's audience, it's going to be FEN March 2021. So write that down if you want to get a Veralytic report on me. We'd be happy to get you one. So with that, Tom, we will open it up for questions and/or actually, since I'm out of breath, Bob, did you have anything to add?
Well, yeah. Could you repeat all that, Barry? No.
Yeah.
A great job, and always enjoy listening to your presentations, and you did a great job today. I find myself taking notes, every minute you're talking, because as I said, we're all evolving, right? We have evolved if we go back to early in our respective careers to where we are now. And then as we look forward, if we think that we're just going to remain stagnant and static and just do things the same way today we did 10 years ago, 20 years ago, 30 years ago, and project that out in the future, can't happen. But one of the things that you've talked about, I know, is the importance of not only having choices, but being objective, which we try to live by that every single day of the week. But you talk about disclosure, which you did a great job of doing today, and the importance of taking it a step further. I mean, I can sense that there might be some agents and advisors on today who are saying, well, I live in the state of X and we don't have a best interest regulation, so I'm not going to worry about it. I think that's a very dangerous precept or way to look at this whole thing. Like we've said, where do you want to be? Do you want to be just stay in your cocoon right now? Or do you want to look to where we think, sorry, the puck is going, and prepare yourself with what I think you would agree is the inevitable evolution and outcome, which is that everybody's going to wind up having these best interest regulations for insurance, just like Reg BI at the Fed level and so forth. So it adds in the disclosure, and then ultimately the way that you best do that is to take those search engine capabilities that are out there and combine that with the Veralytic reports, and you can't do a better job than that. So I encourage everybody, and this is an unsolicited endorsement, I know, but I encourage everybody to take a very close look at Veralytic and see how it can improve that fiduciary stance that you're taking with your clients. I'll end with that.
If I can add one more thing, just real quick. I do agree with you, Bob, that there's the stick of the best interest rules, that not following them could lead to some danger someday. I also think it's the greatest business development opportunity that I've seen in my 30 years in the insurance business. Nobody knows what they're being charged. Nobody knows what they're actually getting in performance. The financial advisors that can help their clients understand what they're being overcharged, when they're being overcharged, and actually find them money, it's the best business development opportunity while getting out of harm's way for the future danger that you talked about. So, Tom, do we have questions?
Yeah, we certainly do. We have a bunch of questions. Let me launch just 2 polling questions. If you're interested, and Barry gave you the contact information and the website, et cetera, but if you want Barry's team to contact you to learn more about the Veralytic reports and the benchmarking and some of the features that he mentioned, just opt in here, and I'll make sure that Barry gets in touch with you. Then in a similar way, I'll pose a question if you want to learn more about Bob's services and how he supports financial planners, financial advisors, fee-only, registered reps nationwide. He's been doing this for years. I'll have a question on that. So let's see this open for 3 more seconds, if you could. And then, by the way, for those of you listening, if you're not a subscriber and you missed the beginning, you are welcome to, you could earn CE or CPE credit today if you subscribe in the coming days. And again, I'm going to launch a question as I just finished that thought. If you'd like to learn more about Bob Bandy's Advisors Insurance Brokerage platform, a brokerage general agent, please opt into this question. I've had Bob on the past, in the past, I've had him on several times. They do everything from life to long-term care insurance, et cetera, and certainly supports thousands and thousands of planners and advisors. So really pleased to have both Bob and Barry on today. So again, let's leave it open for 3 seconds. And again, for those of you interested in the CE or CPE, if you're not a member, you could still sign up post-session and earn credit for today. But as I always say, it's really the quality of the education is why I would hope you would sign up. So with that, let me start to rapid fire through the questions here. And for those of you listening, let me just timestamp it. If you need to jump, for those of you listening, it's 5:01 Eastern. You've certainly been on long enough if you were on at the beginning to earn that CE or CPE credit. So here we go. Joel, good to see you on. And Joel, I responded to your email. Hopefully we can continue that offline. But what method do you use to calculate the performance of a permanent life insurance policy? I know it involves premium less cost of insurance and several other adjustments, but I'd like to have a formula to work with. And by the way, Barry, before you answer, I did post the Kitsit's article in the handout section. I think Barry mentioned that. But again, if you don't see that, you can drop me an email at tom@financialexpertsnetwork.com. I'll make sure you get that. So back to Joel's question, Barry.
So on those detailed expense pages, you'll see a column of cost of insurance charges over the entire expected coverage duration. And you'll see expenses, premium loads, admin fees, wrap fees over the entire coverage duration. So the way the Veralytic system does it is it collects all of that data from every single illustration and it throws it into a database, a giant database. And because we have this giant database of all these cost of insurance charges, all these admin fees, all these wrap fees, all these premium loads, we can calculate an average or a benchmark. And so the way the Veralytic system does it, which is not the only way you can do it, but the way we do it is we calculate the present value of all of those costs over the expected coverage duration. And then we relate that to the present value of the benchmarks, calculated the exact same way, benchmark average cost of everything in the database, calculated the exact same way. I hope that answered the question.
Okay, great. Next from Ted, sort of an observation / question. Ted was taught that insurance is a way to transfer risk, that life insurance is a way to transfer and thus avoid risk. It's the only kind based on a certainty, i.e. that we all die. So why is so much risk not transferred?
Bob, you want to take that? Or we can both probably have fun that one.
Yeah, I'm not sure I understand the question other than is he referring to looking at the transfer of risk from a death benefit standpoint, or is he looking at it from a cash value performance standpoint? Maybe we can't tell.
Clarify. We will clarify. We'll come back to that one. Next from Leonard, what?
I'll say,
Yep.
generally speaking, nobody likes risks. I mean, even companies who are in the business of assuming risk, they only want to assume that which they can predict. And they've made some mistakes, as we all do. Like the NAIC model reg is just not, I mean, it's just by their own admission, it's not good. And so the institutions are trying to make money and by minimizing their risk. I totally agree that the intent of the product is to transfer risk, but the products of today are pushing more of that risk back onto the client.
I think that's Ted's view, right? Next from Leonard, I think early on, Barry, Leonard is asking on some of your slides what type of policy illustration you were using, and did you ignore the premiums paid in the year? He was quoting the 13% result. So I think this is where you started with the 5% and then brought in the next slide, and et cetera.
Yeah, so I don't know off the top of my head what, it was a universal life illustration because only a universal life illustration would have the detailed expense pages. I don't know off the top of my head, nor do I really care, because as I mentioned during the comments about the Kitchis article, that it is not product, the practice of calculating hypothetical premiums, hypothetical cash values, and hypothetical death benefits based on a rate of return that may or may not be consistent with historical returns for the assets required for the assets underlying policy cash values is not unique to any particular product type. So it's definitely a universal life policy. Did I answer the question, Tom? Was that it, or was there a part B?
I think so. Leonard, if you want more, just post back
Email
again. Mike, Michael asks about the reg or guideline AG 49. I think it's 49A. Not quite sure I understand the context there, but if you want to comment on that, Barry and or Bob.
So AG 49A is the latest iteration in the NAIC illustrations model regulation.
Right.
The NAIC model regulation basically prescribes a formula. And if there is a formula, then somebody can game the formula. Versus to Bob's point, transparency and disclosure. If you give the client what they're actually going to be charged, if you give the client what is actually required to make the policy work, and if you have a conversation about the risk involved of getting that or not getting that, there's no way to game anything. So AG 49A is the next attempt, the next in a series of attempts to tweak the formula under the NAIC illustrations model regulation. I don't think the formula will ever work. I just don't. Bob?
Okay. Bob?
Yeah, I would. My only other thought, in addition to what Barry so aptly put, is just that it's a bit of a patchwork approach, so to speak. You had the original AG 49, and we've seemingly come back to revisit it because of that gaming of the system, right? In other words, the people who are designing the policies, and by extension, I suppose, the people who are designing the illustrations, in an effort to be as competitive as possible in this very competitive environment that we live in as an industry, have gotten, how should I put it, creative with regard to how they insert certain criteria into the performance of a policy to make it look better on paper. And I think the most recent iteration of AG 49A is yet another attempt to curb those abuses. But again, it's a patchwork, and it does not go to the extent that Barry's analysis with Veralytic does. It doesn't, it's a step in the right direction, I think, if that's fair, but it doesn't go as far as it should, in my opinion.
I mean, the NAIC illustrations model regulation has been around for 4 decades. They've amended it a number of times. And when I'm doing this presentation live, I'll ask for a show of hands. Has an illustration, the goal of the NAIC model regulation is to make illustrations more understandable, and less misleading. I said, in the 4 decades that the NAIC has been at this, has anybody found that illustrations have become more understandable and less misleading over those 4 decades? And not a single person ever raises their hand. So
Right.
I'm not sure why AG 49A is going to be any different than the last 4 decades.
Yeah, right. By the way, breaking news, my $150 AirPod from Apple burns out on me after an hour. But hey, I digress. Sorry, I have these tech troubles. But anyway, Dan is asking, I would think a guaranteed universal life policy with the guarantee, one wouldn't be as concerned with the apparent smoke and mirrors within an illustration. Could you please comment on this?
Totally agree. In fact, I think that ties back to, was it Lawrence, or there was, who had the question about risk shifting?
Leonard.
Ties back to Leonard's question. Guaranteed universal life is the one product that really shifts risk. And for those who have been cognizant of what has happened to the pricing of guaranteed universal life products over the last decade, the price of those guarantees has gone up considerably, in part due to some changing in the way that they have to calculate their reserves for those products, but also in part because they were just mispriced. The insurance companies made a mistake categorically. The product will shift risk, but the insurance companies underpriced that risk, and they have significantly increased the cost of those guarantees from 10 years ago. But it does shift risk completely.
The only thing I would add to that, I agree. And the only thing I would add is the only cautionary addition I would make to that is make sure the premiums are paid and paid on time, because that's where some policies can get your client into a little bit of trouble. Not all of them allow what are called catch-up provisions or offer them the same way. So yeah, as long as the premiums are paid and the premiums are paid on time, you're absolutely right. Just want to make sure your client is being cautious there.
Really good point. So there's economic risk, pricing and performance risk in the non-guaranteed products, but there's administrative risk in the guaranteed products. Because if you don't administer it right, you may be worse off than you would be without the guarantee.
Yeah, right. All right. Next from Ralph, what is the best phrase to use to clarify the difference in cost when requesting an illustration?
Boy.
Can you repeat that, Tom?
Sure. What is the best phrase to use to clarify the difference in cost when requesting an illustration?
So you won't actually get the difference in cost when you request an illustration. You'll just get the costs. And then you've got to calculate the difference in cost between one provider versus another by some means or methods, or get a Verilytic report. But I think this question may be similar, or is similar to one that I get all the time. You know, how do you go get this cost information? First of all, more than not, unless you're dealing with a organization like Bob's, you've got to ask for it. Bob's part of Bob's, as we've talked, is part of his operating procedures, operating protocols, is they get those cost disclosures every time. Unfortunately, if you're not dealing with Bob or somebody like Bob, you probably are going to have to ask for it. Because the insurance companies call these pages different insurance companies call these pages different things. Even the same insurance company for different products calls it different things. I don't know that there's, a phrase that I can give you, other than the most descriptive phrases that I've found is you ask for detailed expense pages or policy accounting pages, and simply explain that you're looking for the year-by-year disclosure of all policy costs.
Okay, yeah, that's great. I'm looking ahead to some of the questions, and we have more questions around that. I'll try to skip through these as quickly as we can. Let me just circle back here. Oscar asked, and I think this ties to Veralytic. Bear with me one second. Is there a place where we can go to get reasonable analysis of different companies and policies? And by the way, if you want to just, as you're answering that, Barry, comment on whether your analysis, Veralytic's analysis, also includes in-force policies and then the various types of policies that it encompasses. I think that would address a lot of the questions I'm seeing in the question panel.
Yes. So Veralytic reports are available and useful for any life insurance product that has cash value. So the 19 or the guaranteed universal life policies of 10 years ago vintage, you probably don't need a Veralytic report. It's it's like term insurance. There's no cash value. Everything's guaranteed. There's administrative risk, to Bob's point, that you got to pay attention to, but guaranteed universal life policies, you really don't need a Veralytic report. For research about the company's financial strength, the cost being charged inside the policy, the reasonableness of the performance expectations, actual historical performance, and that kind of thing, Veralytic, a Veralytic report will reveal all of those things for any in-force policy or new business proposal relative to the entire universe of peer group alternatives.
Okay, and what's the cost, Barry? A few folks are asking about the cost of Veralytic. So I'm assuming it's a per seat subscription model.
Correct. $199 a month, unlimited use. That is our single user subscription, which I know that many financial planning practices don't do a lot of life insurance. And so if it was a practice where there was one life insurance specialist in the practice and they had two other partners or so, we would still call that a single user subscription.
Okay, good to know. This is from Michael. Any thoughts on life expectancy reports for older age clients in order to customize premium based on actual life expectancy?
Useful tool. That is not part of the Veralytic report, but absolutely a useful tool. Life expectancy reports calculate the average. That's like somebody said somebody once told me, I don't know if this is true or not, but many of your audience may have heard this too. The average depth that people drown in is like 3 feet or something like that. I mean, the average is just not indicative of any individual's circumstance, or it's not predictive of any individual circumstance. But if you've got somebody who's got impaired health and you got a policy that requires a lot of premium to make the policy last, out until maturity, I think a life expectancy report is very useful in kind of understanding trade-offs, trying to find the balance between trying to quantify the risk of outliving the coverage versus not, and I think it's very useful for planners. Maybe Tom, that may be an idea for another webinar. One of our customers is in the business of doing life expectancy reports, so that might be a fun topic if you get enough interest in that.
Geez, I never thought I'd say life expectancy might be a fun anything, but okay, we'll run with that one. Bob is asking, how does whole life fit into this picture? I think you've sort of commented, but if you want to comment again on that, Barry, please.
Sure. So, whole life is bound by the same economic rules as any life insurance policy. There are cost of insurance charges, there are premium loads, there are admin expenses, just like all life insurance policies. So that same formula, cost of insurance charges plus expenses minus the interest earned, that offsets those cost of insurance charges and expenses. Whole life is bound by this, economically bound by those same rules. Whole life, by its design, does not disclose those elements. So they're harder to get. I have seen financial advisors in big cases ask an insurance company for that information, and the insurance company will have an actuary actually calculate it. So it's clearly available. But you can also, the Veralytic system also extracts that information from a whole life illustration just before it measures it. So another way to get that information on a whole life policy is a Veralytic report.
All right, great. And we're going to, again, continue on through the questions. But Barry, if you don't mind going back to the previous slide, just for those that want to see that promo code again. And Kevin and some folks have asked about that, just to, to make sure that you see that code. And again, if anyone has questions post-session, just let me know. I'd be happy to make sure you get the right information. Give me 1 second. Let me go back and find this one question. Okay, this is from Chad. Isn't it possible that benchmarking alone may not ultimately determine what is in the best interest of the client? For example, could not contractually guaranteed interest bonuses and/or no lapse guarantee riders offset comparably higher policy costs? Shouldn't the reasonable expectation of total premiums paid be part of the best interest? Does that make sense, Barry?
Totally. This is something Bob and I talk a lot about. In fact, I don't think benchmarking determines anything. Benchmarking is just a more reliable source of decision support. A Veralytic report won't actually execute the trade. A Morningstar report won't actually execute the trade. It won't get you into the mutual fund. A Morningstar report won't tell you the right asset allocation for a client. So benchmarking or research services like Morningstar or Veralytic, they are not determinations. In fact, I'm going to segue in just a second. They're not determinations. They're reliable sources of information for fiduciaries to navigate the path toward clients' best interests. And all those things that questioner asked are considerations that all go into the input for what is and what is not in the client's best interest. Could not agree with that questioner more. I will use that to segue really briefly. Morningstar measures one thing. They measure risk-adjusted performance. We measure 5 things, as we talked about earlier. We measure financial strength, claims paying ability, cost competitiveness, the stability of those illustrated representations, the accessibility to cash value, and the actual performance of invested assets and underlying cash values. So we're measuring 5 things. If one of those 5 things are not important to a client, then a 4-star policy could be just as good or better for a particular client situation than a 5-star policy. Again, it is not the Veralytic report that determines best interest. It's the advisor, but the advisor needs what Bob is talking about, reliable information, and then he needs a place to go that'll get best execution, which again would be somebody like Bob's firm.
And if I can add to that, right on, agree with that, Barry. The other point that I would add there is that, as you're, and I'm going to inject a little bit of home state Reg 187 best interest from New York here. I mean, the reality is that best interest is not a problem until it is. And then once it is, if you find yourself in a courtroom or if you're litigating, the bottom line is you better be able to defend what you put in front of the client. And as they've been actually very clear in Reg 187, they've been very careful not to say that, the policy with the most kind illustration. And they might even look at Veralytic and say, it doesn't necessarily mean that the policy with the top stars in the Veralytic report is the answer. It's just that if you decided to go with option B, which was not that, what did you use for criteria to justify that as your recommendation to the client? And you've raised a couple of things that I think would be apropos as part of that conversation.
Well, interestingly enough, Barbara had asked how Veralytic compares with the Morningstar workstation for life insurance policies. I think you address that spot on. But Barbara, let us know if that's the case. Barbara had also suggested, as we've had in the past, Barry, I think the next time you come back on to fire up Veralytic and show a live demo would be of great interest to many. So love to have you back to do that.
We've actually got a 5-minute demo of the Veralytic system that is better than I can do live. And I can email that to you, Tom, and you can distribute it, or I'm happy to send it to anybody who's interested.
If you send me the link, I'll make sure to pass that along. Next from Stacy is asking, what is your opinion of hybrid policies, life plus long-term care? And both of you on that.
Well, I'll take it first, and I think there are two answers. One is a standalone answer in terms of what do I generally think, and then there's probably the second answer has to do with within the context of today's conversation. I think, yeah, getting back to really what we were just talking about, it's all about the client situation. What are we trying to accomplish for the client? And if that client's needs are best served by a hybrid / combo / link benefit, whatever type of product we're actually talking about, and that satisfies the need of the client within the context of what we think is their best interest, then certainly it's valuable. And I think on balance, getting back to the point that I was just making a moment ago, again, if you're comparing policy A, which performs with stars and stripes and fireworks in Veralytic, but doesn't have a benefit to pay for long-term care or chronic illness, as opposed to one that's fairly close, but does have a benefit for chronic illness or long-term care, is it conceivable there could be a case made that that's in the best interest of the client? I think the answer is yes.
Totally. That's back to the earlier questioner's comments about, what are the other considerations? I could not agree more. It's all about, matching up goals, objectives, the client's goals, objectives, circumstances, and constraints with the product that best meets those goals, objectives, circumstances, and constraints, as determined by the most reliable or as reliable information as you can get. I could not agree more with what Bob just said.
I would say, Stacy, if you haven't seen the past webinars section on the Financial Experts Network site, good reason to go there is to listen to Bob's presentation. I think it was in October on various long-term care insurance options, and did a great job there. So again, under past financial advisors, past webinars on the Financial Experts Network site, I'd encourage you to listen to that. Okay, great. I think unfortunately David left, but he had this question: how do you bring underwriting into the equation? When he gets life insurance for clients, he tries to go with the company with the best underwriting. For term, it's easy, but for UL policies, what do you suggest?
So absolutely, positively an important consideration. And so as the son of an actuary, I'll answer it kind of mathematically. So as we discussed earlier, there is as much as an 80% variance between good and bad pricing. Every carrier is a little bit different, and so this is a rule of thumb. A rule of thumb is always wrong, but it's representative. So the difference between standard and preferred is 8%, right? So if you had a company that was number one best available rates and terms at standard, and then you had another company that was number two best available rates and terms, but they were willing to go to preferred, then that would make a difference. If you had a company that was on the wrong, it might illustrate a low premium and they might talk about their underwriting, but if you actually looked at the detailed expense pages, you see that their costs are high and the risk is high, and so a better underwriting offer from them will not get you, unless your client is high risk and wants to pay high costs for. And by the way, back to that questioner's point about matching up clients' goals, objectives with circumstances and constraints with products. there's a $3 trillion hedge fund industry that has high costs and it has high risk. And there are lots of people who put their money there. So I'm not saying that high costs and high risk are not appropriate for some. I'm just saying that it is important to understand the costs and understand the risks so you can then match that up with clients' goals, objectives, circumstances, and constraints.
Great. I think we've gotten through most of the questions. I'm just scrolling back. Please feel free to post again if I didn't answer your question. Ted always has an interesting perspective and has this question, which is your analysis. In your analysis, I think you mean, Ted, is which gets us to the best policy guaranteed?
The best policy guaranteed would be and you don't need a Veralytic report for this. You would go to Bob. He'd go to the search engine, and you'd look for the policy with some combination of the lowest premium, the longest coverage, the lowest guaranteed premium for a given death benefit, the longest guaranteed coverage duration from the company that has the highest financial strength and claims paying ability ratings. You don't really need a Veralytic report for that, but that's how I would look for the product in a conservative client's best interest.
Agreed. It was interesting. It was interesting too when we were having some of the preliminary discussions. We looked at some samples of some of those search engine examples that we use internally, and we did see a pretty wide variance. And one of the things that the search engine showed was, there's separate columns, and you can give more prominence to one column or another. One of those columns is the guaranteed cash value for that given amount of guaranteed premium. So yeah, there is there's value to that. I mean, I guess it's like the polar opposite of the hedge fund example that Barry was just giving. Certainly the other end of the spectrum is the same.
Yeah. Okay, great. Well, again, I think we've worked our way. You two did a great job working through the questions very quickly. I just put up on the screen, we'll hold it up open for one more minute, the upcoming webinars off the financialexpertsnetwork.com site. Next up is 4 pillars of life and legacy planning. Looking forward to having the co-founders of Everplans on Thursday at noon, and then some interesting sessions next week, including charitable remainder trust. That's always a hot topic. Reverse mortgages with my friend Larry Kotloff, and I'm actually presenting that one. So hope all of you can make that. And again, check the site for much more. And I'm just going to hold it open one last minute. I think we made it through. You guys made it through all the questions. So Barry and Bob, certainly really appreciate all the effort you put into this. There was a lot of prep that went into this, folks. I would say that, and certainly it came through very, very well done. So with that, I'm going to wish everybody a happy St. Patrick's Day a little early. I will tell you, not perhaps celebrating as much as we normally would, but it hopefully puts a little kick in everyone's step tomorrow. And Barry, Bob, you two doing anything exciting for St. Patty's Day?
Pretty quiet on this end. And I'm sorry I didn't wear green today. I didn't think of it this morning. My bad.
No.
Yeah.
Barry?
I'm trying to clear the decks for leaving town to go to the North Georgia mountains to celebrate my daughter's 30th birthday. So I don't even know what day St. Patty's Day is. Just kidding. But it feels like I don't.
Yeah. Well, yeah. I hope everybody. Well, we're moving towards better days, brighter days, and being back together. So certainly look forward to that. So, all right. So on behalf of everybody, again, thanks to both of you. Well done. Thanks everybody for listening in. Already getting lots of great comments. Please participate in the survey. And hopefully we'll see you back again Thursday at noon. And gentlemen, wish you both well, and look forward to doing it again soon.
Yeah, it was really fun. See you. Bye-bye, everybody.
Okay. Thanks, everyone. Take care.